When we think about, the environment you're in, people think about this conference as the 8th leverage finance conference, but really, this is a conference that goes back to the late 90s over at Goldman Sachs. It used to be run by David Solomon himself as well. You have the special challenge of leading it this year into a lot of recession fears.
Well, based on the activity level in the bar last night, people are pretty upbeat. We have a lot of good things here. We've got 82 clients that have come to see us, over 400 investors. And I think, folks really would like to continue to learn how to put money to work in a challenging environment. And even though volumes are down, the technical picture looks very strong in terms of, we've got the backlog at a very modest level. The forward pipeline looks reasonable. And, I'm optimistic with some of our M&A colleagues that are here talking at the conference. The activity levels are really picking up.
Now, there's a lot of concern out there in the market about the delayed effects of the Federal Reserve rate hikes. You're working with a lot of leveraged borrowers, particularly companies, some with floating rate loans that are feeling the impact of higher interest costs. How delayed is the effect? Is there kind of more pain to come when you look at kind of the riskier end of the spectrum here?
Well, I think most of our clients are very sophisticated, and when the Fed started to move, they really got ahead of their interest rate management. And so I think client by client, they have a very specific strategy how to hedge rates. Obviously, everyone's focused on interest coverage, and that's something to keep an eye on. And look, depending on what you think, with the Fed potentially making a couple more moves, people are going to continue to be very wary about managing that interest exposure. I think on the positive, the markets are open, and we've seen a tremendous amount of refinancing activity. And so if you take a look at people's duration in their portfolios, a lot of work was done in 21 and even parts of 22 to push their maturity headlines out. So if you look at the maturity wall that people talk about, it's really not coming for another couple years. And so you're right, we have to manage cash flows and interest expense going into this period. But I think most companies have been very proactive.
Cash is king, and that is certainly true for large corporations now that want to keep a healthy balance sheet going into any potential further tough times. What about unprofitable companies? Are investors willing to put money up to help these companies kind of through?
I think what we're seeing, a couple things. Number one, any transactions, new transactions, you're just going to need more and more equity to finance them. The good news is our private equity clients have raised an inordinate amount of capital. As it relates to existing capital structures that are cash flow negative, I think you're going to see a lot of self-help, and we're starting to see that as well. Big pools of capital have been raised, including by our own private wealth and asset management teams, to basically raise capital that can go in, de-lever an opco, put in a preferred at the holdco, and buy company time. So it's an opportunity as well as a risk.
Let's talk about buyouts, because there's a lot of questions here. They're finally slowly starting to come back, and you're seeing some big financings at scale. It seems like this market of kind of hung debt is starting to clear up a little more. When do deals reasonably come back at scale, and how willing will Goldman be to finance them?
Well, number one, we're very proud to say, even right after the invasion and the volatility of last year, we've never stopped writing commitments, and that was very important to us to support our clients. Number two, there have been transactions announced. Even through last summer, we were involved with classic, committed financings and commitments that were done through the end of last year and even to the beginning of this year. When you look at a couple of stats, it's sort of interesting. The average number of take-privates over a 5-year period, I think it's been 64 deals. We're already over 100 in 2023. So that just tells you something right there. Now, as it relates to when do I see the mega transactions coming back, those will take more time. We have to really rely on the continued healing of the institutional financing markets. But as you know, the direct market has really stepped in a big way, including our own asset management team. And so there are a couple of interesting statistics there. I think last year, in terms of volumes, there was something like $90 billion done in our market and $72 billion done in the direct market. Year to date, that number is $19 billion in our market and $11 billion in the direct market. So both markets are functioning, and both markets are very healthy, and the evolution of that market has really helped our clients avail themselves of capital in challenging moments.
How competitive is it? There's we were joking kind of before this that you have KKR here. On one hand, they're a client. On the one hand, they're a huge competitor when it comes to financing markets. First and foremost client.
Yes.
But really, the financing markets from the private side is very significant. The deals are getting bigger. You look at right now one of the largest deals on record in the market. And so how hard is it to compete from where you're sitting?
The way I think about it is they're both great options. And so when we look at it, because again, we have a resident inside large private credit business. In fact, I think we're number 3 in the world, right? So for us, we like to show our clients, you can try an institutional deal, we can look at a direct credit deal. So we think of them as just options. They do compete, and there's a really good example recently of a transaction where the direct market stepped into a $5.5 billion commitment for a client. November of last year, things were pretty challenging. And last couple of weeks, it was actually refinanced in the institutional market, saving the issuer over 320 basis points. That's a good dynamic for our clients. They have 2 sources of capital to compete, and they can find the sources that are the most, effectively supportive. So we're pretty excited about both markets. We think we can coexist very happily. And again, at Goldman, because we have a direct credit lending business, it's very significant and growing, it's a good thing.
It's kind of what you're saying here, that the increased competition is kind of keeping costs down for borrowers.
Yes, 100%.
So that's interesting. When you kind of look ahead then as well, if you are waiting for this market to kind of come back, you're seeing
the mega deals.
The mega deals.
Back. We're functioning. We're financing deals. The markets are functioning, but the mega deals.
Talk about that a little more, because you're seeing kind of investment grade come back at such a large scale.
Yep.
So what is your expectation for activity throughout the end of this year when it comes to the more leveraged borrowers?
I think we're going to see in the direct market continue to grow, which is a good thing. I think that assets under management is growing at double digits. That's not going to change. Those deals seem to be getting bigger and bigger, as you mentioned. I think the one you're referring to is roughly $7 billion. On the institutional side, I think we need to really continue to see the CLO market continue to heal and new CLO generation really kick in. And I think we need a little bit more clarity. Honestly, you mentioned the Fed. And then really, where are we with the economy? Jan Hatzius, our chief economist, had dinner with us last night, and he thinks people are just a little too negative. He tends to think we have a very good chance of landing this with a soft landing. But if we have a little bit more clarity around the economy and the Fed, and the CLO engine continues to heal, I think we're going to be in a much better place towards the end of this year. And the activity levels among sponsors is really picking up.
This idea of a Fed pause or even a cut at some point, how much pent-up demand is there for that event in terms of kind of coming to new issuance in the market?
I don't think that is much of a driver, is confidence in the depth and the resilience of the market. And I think CEO confidence is also super important, and the confidence level of IC committees. When a deal is presented at committee, we see it in our own committees. How confident are you in those projections? How confident are you in that market position and the backdrop? And one of the things that this conference hopefully brings to bear, we have people talking about the consumer, commercial real estate, the economy, the political landscape. Let's not forget we're going into an interesting political cycle. So there are a lot of things to be focused on. Fed's one piece, but I wouldn't over-index to the Fed.